All right, let's talk about a name you've probably heard of, maybe even used yourself. Urban Company. They're one of the hottest startups out there, and now they're going public. But here's the real question, right? Just because you love the app, does that mean you should love the stock? Let's dive in and break down this massive IPO. So, the very same company that can get a plumber to your door with just a few taps on your phone now wants your investment with a click of a button. We're going to dig into Finmagene's deep dive report to answer that one simple question. Should you click buy? And look, this is no small deal. We are talking about a massive 1,900 crore rupee IPO. I mean, a number that big, it definitely gets your attention. So let's figure out what's really behind that number. Okay, so first, a super quick refresher. Urban Company kicked off way back in 2014. And since then, they've pretty much become the go-to platform for any service you need at home. We're talking beauty, wellness, repairs, you name it. They took a totally chaotic market and organized it. And now they're taking the whole show public. So let's start with the good stuff, the bull case. Why is everyone so hyped about this? Well, the story they're telling is really compelling. And honestly, at first glance, the numbers look seriously good. And this isn't just marketing fluff. The Finmagene report puts it really plainly. Urban Company isn't just another player in the game. They basically are the game when it comes to organized home services in India. They built this brand that people really know, and even more importantly, a brand they trust. And that trust, it shows up right in the bank account. For fiscal year 2025, the company brought in 1,260 crore rupees. That's solid proof that there's a huge and growing appetite for what they're offering. Now this number is a big one, 82%. That's their customer repeat rate. You know, for any business that deals with consumers, that is the absolute holy grail. It means more than 4 out of every 5 customers are coming back for more. That's the sign of a business model that is incredibly sticky. So, where is all this cash coming from? Well, the main engine, no surprise, is their core consumer services. That's 77%. But here's what's interesting. Look at those smaller slices of the pie. Their international business and their own line of products. They're still small, but they're growing like crazy, which gives you a hint at where the future growth could come from. So let's just wrap up the good side of the story. They're the market leader, they have a brand people trust, but here's the secret sauce, I think. Their investment in training. They spend a massive 22% of their revenue training their professionals. Think about that. That creates this huge wall that makes it incredibly difficult for any competitor to come in and match their quality. Okay. So everything looks pretty fantastic, right? But you know how it goes in investing. There is always a but. So now it's time to flip the coin over because, yeah, there are some pretty big reasons to be cautious here. I mean, it all sounds a little too perfect, doesn't it? So what's the catch? The Finmagene report actually highlights a few really critical issues that every single potential investor has got to know about. Okay, the first and probably the biggest worry has to do with this thing called an offer for sale, or OFS. It's actually pretty simple. Instead of the company raising money to grow its own business, an OFS is when the existing shareholders, the founders, the early venture capitalists, sell their own shares to you, the public, and they pocket the cash. And this chart right here just lays out the problem crystal clear. A staggering 75% of this entire IPO is an offer for sale. Let that sink in. Most of the money raised, about 1,428 crores, is going straight into the pockets of existing shareholders. It's not being reinvested in the company. For investors, that can be a big red flag. It kind of makes you ask, do the insiders think the best growth is already in the rearview mirror? Now, let's talk about risk. On the left, you've got the amount Urban Company is fighting over in a GST case, 38.1 crore rupees. On the right, you see their profit before tax for the year, 37.1 crore rupees. Do you see the problem? The potential bill from just this one legal issue is bigger than their entire profit for the year. That is a serious cloud hanging over the company. And there's more to keep an eye on. Their recent profitability got a big boost from a one-time tax thing. Their international business, still losing money. And importantly, there's been a history of protests from their service partners, the very people who are the backbone of this whole business. So, on one hand, you have a great business. On the other, some really serious risks. How in the world do you weigh all of that? Well, this is where the Finmagene scorecard comes in handy. It gives us a really structured way to look at everything from all the different angles. Take a look at the scorecard. You see these really high scores for their competitive position and pretty solid scores for growth. That's great. But then, look all the way at the bottom. Valuation gets a pretty weak 4.4 out of 10. And that, right there, tells you the whole story in a nutshell. It's a great company, but it might be hitting the market with too high a price tag. So when you mix it all together, the final weighted score comes out to a 6.8 out of 10. What's the takeaway from the report? Basically, it's a quality business for sure, but it's one that comes with medium to high risk, and that risk is mostly coming from the way the IPO is structured and that high price. So, with all of this information, what's the final call? What should you, as an investor, actually do? Let's get to the bottom line. And the final recommendation from the analysis is pretty clear. Wait and watch. Now, this isn't saying never buy this stock. It's more of a signal that, hey, the business is strong, but this IPO price, it might not be the best time to jump in. The report actually gives you two ways to play this. If you are a true long-term believer in the company, maybe putting in a small strategic amount right now makes sense for you. But the recommended path for most people, it's to wait. Just wait. See how the stock does after it lists and look for a better, cheaper entry point once all the initial IPO hype fades away. And that really leaves every investor with the most fundamental question of all. Are you buying a fantastic company at a fair price, or are you buying a fantastic company whose future success is already baked into the price? And that, my friends, is the multi-billion-dollar question you have to answer for yourself.